Good morning. Welcome to America First Wealth Management Investment Outlook for November 4th, 2024. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First Wealth Management. Previously in the past, Michael Chia, who headed up fixed income, joined us, but I'm sad to report today that Michael Chia is no longer with America First. And we want to thank him for his contributions and myself personally for his wisdom and continued friendship. Uh, with that, let's continue to bring you the investment outlook that we've been putting out on a weekly basis. This is November 4th, day before Election Day. It's a very critical week, so we'll try to give you some insights on our thinking here. But first, let's provide our standard disclaimer. We're not offering any investment advice here. We're just giving recommendations, and our opinions are based on data up to date and subject to change without notice. And you can read the rest of it, but let's continue. So what we like to do is start off with our conclusions and our outlook first, and additional data later on. So obviously this is election week, and let's call it madness because it will be a very volatile week. In terms of the election, it's now looking like it's going to be a close race. I'll talk a bit about the betting markets that and the data there. The question is, will there be a clear winner? And obviously, in past close elections, there has been a large degree of volatility, and we expect that to continue. A lot of people were talking over the weekend about Warren Buffett, Berkshire Hathaway's huge cash pile, which is now, for the first time, over $300 billion. So Berkshire Hathaway is sitting on $325 billion of cash, and they also have freezed buybacks of Berkshire Hathaway stock. Our opinion of this is that clearly it's a warning sign, but it's not necessarily a good timing indicator because Berkshire Hathaway has been raising cash for the last 9 quarters, and that cash would have been better put to work, obviously, because the last 9 quarters we've seen record growth in the stock market led by the S&P 500. So in terms of a timing indicator, it has not been a good timing indicator, but clearly a warning sign, and patient investors with a lot of wealth to protect should be taking that as a warning sign, but not necessarily a timing indicator to be out of the markets. Listeners and followers will note that we have talked about the current bull market being in a 2-year anniversary, and historically, previous bull markets have averaged about 5.5 years of run before it finally faded away. So we're still less than halfway there in the current bull market cycle. There might be some pullbacks, but clearly with Warren Buffett sitting on a lot of cash and being a classic value investor, he's looking for opportunities to invest, not to stay on the sidelines and not do anything with it. So even if there's a pullback, it's obvious that Berkshire Hathaway will be looking for good values to put that money to work. The next president, whether it's Harris or Trump, is going to inherit a very strong stock market, a weak economy, rising unemployment, and continued inflationary pressure. So it'll be a tough job that will be tougher with the backdrop of a strong stock market. The key macro data points will be Tuesday, Thursday, and Friday. Tuesday will be ISM Services PMI. Consensus is 54.3, previous was 54.9. So we're looking for a slight decrease there. The Fed interest rate decision is shifted to Thursday at 3 o'clock. Consensus is Fed funds rate of 4.75, a 25 basis point decline from the previous 5%. Be very interesting to see if they do that. if they do cut rates again following the 50 basis point cut, it's a clear sign that they are probably less concerned about inflation and more concerned about the labor outlook. And wrapping up with the key data points this week, Friday, 11 a.m. will be the Michigan's Consumer Sentiment Index. Consensus is 71, slight increase from the previous of 70.5. Turning to the betting markets on the elections, Poly market in the previous week had Trump leading by almost 65% versus Kamala Harris's 35%. But as of yesterday, Trump is still in the lead, but his lead in the betting markets dropped, according to Poly Markets, 56% versus Kamala Harris is about 44%. So Kamala is making a improvement in the betting markets. But again, that's betting markets, not actual votes. So we'll have to wait and see what happens with the actual voting. Turning to the regulated betting markets in the U.S., Poly Markets, as people may know, is a cryptocurrency betting marketplace not available to U.S. Investors. Kalshi is a regulated U.S. betting market where U.S. gamblers can actually bet, indicating a much tighter spread within a 2% margin of error, with Trump leading by 51%. Versus Harris's 49%. And during the weekend, I believe it was actually Harris got up to 52% and Trump had slipped down. But as of this morning, Trump is leading by a slight edge in the betting market, indicated by Kalshi. Want to give a look at how the S&P 500 performed pre and post election years. This dates back to the post-World War II era. And just want to note that the average returns, average and median returns to election day were about 4.9% and 4.7%. So 83% of the time returns prior to election day during an election year were positive. From election day to the end of the year, however, the average is much lower, 2%, and the median was a bit higher, 3.7%, but positive only roughly about 2/3 of the time. So clearly, after election day, markets have tended to be weaker. So that's what the historical averages are showing. And let's look at it a little longer perspective in the 6 months prior and the 6 months after. And this is previous election years as well. 6 months after the elections, the averages tend to be lower, and that's something to take note. So it might be a good time to follow Warren Buffett's lead and have some dry powder, because there might be some trepidation and fear, and investors heading to the sidelines. This is an interesting chart, and we leaned heavily in the Kobayashi letter, which is a great letter that's available on x.com. This looks at the average volatility around the elections from 1928 to 2020, where if the incumbent party won, which is shown in blue, the volatility tends to be lower. But if the incumbent party lost, the volatility is a bit higher. So if Trump wins, you can expect volatility to increase if this follows the historical averages. Turning to Berkshire Hathaway's cash pile, and this graphically shows the huge spike up in cash. And again, do want to point out that the buildup in cash came at the opportunity cost of not being invested as the stock market rose to record highs. Um, Looking at the flip side, what have mutual funds been doing? Cash levels in mutual funds are now down at the lowest level um, since 2015. So, which is kind of interesting because mutual funds are obviously fully invested, and Warren Buffett uh, has a huge increase in cash. So many Buffett watchers have heard one of his famous quotes, be fearful when others are greedy, and be greedy when others are fearful. So um, probably a good indication of how Buffett feels about market valuations and his fears expressed by the heightened level of cash. Turning to the weekly market stats, in the week prior to the election, it was clearly a weaker stock and bond market, pretty much down across the board. Um, there was a lot of earnings last week, and the earnings, by and large, my sense was that it was decent, but the guidance and outlook, and also the upcoming fourth quarter growth rates are going to look a little bit lower. So markets could have been selling off based on concern about the election and perhaps some concern about equity earnings outlooks. Turning to Magnificent Seven, we had Alphabet and Amazon were up strongly, but the rest of the Magnificent Seven names were down. Sector performance, only the communication and services sector was up. Financials were flat, and all other sectors sold off. The interest-sensitive sectors, real estate and utilities, were impacted by the increase in interest rates. S&P 500 chart, as we said last week, we're below the 10-day moving average, and we're still below it. The RSI is dropping, so we're clearly in a distribution weakness period for the S&P 500, as investors are probably moving to the sidelines. 10-year Treasury yield continues to rise, ended the week at 4.37%, jumping 12 basis points week over week, and is now up 49 basis points year to date. So clearly, this is going to have a effect on cooling down the markets, and we clearly have seen that happen. Yield curve has also risen. The shorter end has dropped versus the prior week and since the end of the third quarter, but clearly you see the November 1 yield curve, which is in blue, having clearly risen at the longer maturities. Flipping over to the economy. One of the things that concerns us is the weakness in the private sector, not the overall job sector, which includes government jobs, which has been going up. Private sector jobs clearly down 28,000 private sector jobs in October. It's the first net loss since December of 2020. And private sector jobs now have fallen 1.5 million year over year. And we've never seen a drop of this magnitude outside of recession. So it's could be a clear indicator that we are in a recession. Turning to unemployment, we clearly see that there's permanent job losers as a share of civilian labor force. We can see the unemployment rate here clearly rising, and that's a concern. It's kind of hard to see, but we do have the recession periods marked, and rising unemployment is usually a good sign that we're in a recessionary period, and this continued increase is troubling. And why might that be the case? Small businesses, by and large, are the largest employers in the country, and short-term loans, which quite often are the lifeblood of small businesses to manage their payrolls and supplier costs and paying their expenses. Higher interest rates are squeezing liquidity from small businesses, and they typically have to contend with this by cutting expenses and jobs. So this is a concerning problem, and we're hopeful that when the Fed reports on Thursday, they will take note of this as a advance warning sign of economic slowdown, even though they are principally concerned with core inflation going up, um, rising rising unemployment should send a warning flag, and hopefully the Fed will take heed and do the right thing in terms of hopefully meeting the consensus drop, 25 basis point drop in interest rates. Uh, Turning to the quarterly earnings growth rates, and this is looking at consensus growth earnings, uh, which clearly strong into for the end of the third quarter numbers. However, the fourth quarter consensus growth does look like a drop, while it's still positive. As we know, the market looks for increase growth rates rather than decreasing growth rates uh, to drive further growth in the stock market valuation. So um, this could be a troubling sign, especially with valuations high and cash levels going up, especially by Warren Buffett, and cash levels being low at mutual funds. That could be a concern if mutual funds managers decide to raise cash. Turning over to energy. Energy's been a sector that's been lagging all year, and we thought it was useful to highlight that there's going to be some potential for rising energy prices. This is a chart showing surging excess liquidity of the G10 countries. And historically, this has been a good indicator when there's been excess liquidity. Um, oil prices tend to follow. Um, so this is a indicator that we like to follow. Also looking at the supply, inventory levels are starting to come down. So with the higher liquidity and inventories coming down, countries will tend to increase their strategic storage reserves. And while I don't have the chart here, the US SPR is still at near low levels, so we suspect that they're taking advantage of the current low energy prices to increase crude oil storage in the Strategic Petroleum Reserve. And this is probably a prudent move as we come into the winter months here. Turning to gold, which has been quite dramatic. I love this chart. This shows gold since 1980 and highlights a lot of the major um, events since the 80s and how gold has behaved during that period. So we are at record highs in gold and uh, strong buying in ETFs, which I'll show shortly. But it's all signs point to increased price levels in gold. Looking at gold versus Bitcoin, this is since the start of Bitcoin. Um, Bitcoin obviously has been a lot more volatile. On a percentage basis, it's increased a lot more than gold, obviously. But lining up the chart side by side, you can see clearly in recent years that Bitcoin is quite volatile, uh, has led gold for some period, but now gold is catching up in terms of the rise in the stock price. I'm sorry, in the price of gold. ETF flows. This shows the gold price is the linear line, and the inflows. This is the sum of all the gold ETFs around worldwide, and you clearly see that year to date, retailers have been net purchasers of gold ETFs. On the other hand, central bank gold buying is still quite strong, well over 600 tons. But for 2024, it's going to look like it's lower, going to come in lower in terms of gold buying than the last 2 years. Um, so this is um, central banks are obviously pretty smart in the last couple of years to increase their gold allocation. They're slowing down, possibly due to the higher price of gold, but or they might be doing other things with it. So we'll keep an eye on what central banks are doing. Coming into the elections, we can see a huge increase in the Bitcoin ETF, the BlackRock Bitcoin ETF. Huge spike up in inflows there. So it does look like many investors are taking some evasive and protective actions by being in assets that are uncorrelated to both bonds and stocks. And gold and Bitcoin seem to be the beneficiary of that diversification. We are going to skip the earnings for the week. There's still quite a few. It will be an important earnings period, but I think the earnings will be overshadowed by the election as well as what the Fed does this week. We'll still pay close attention to the earnings, of course, but on a macro level and a political level, we think those will be the drivers for the market. And with that, viewers and our customers are welcome to contact us directly by reaching out to myself or Jim Monahan here, and that's our contact information. And we want to thank everyone for tuning in this week, and we look forward to seeing you next week. And have a great week. And we do predict that the elections will be completed and the sun will rise again the next day. And it's good to know that investors like Buffett are sitting on a lot of cash waiting to get invested. So that could be considered a backstop to any volatility. And definitely there'll be some good opportunity. We do always suggest that investors have some dry powder and be ready for great values when they come forth. And like Buffett says, we shouldn't be betting against America. It's always good to bet with America. So with that, we're signing off and look forward to seeing you again next week. Take care.